If I only had $1,000 to invest in 2026 and I was starting from zero, this is exactly how I would do it using ETFs. No individual stock picking, no leverage, and no guessing which company might be the next big winner. Just a simple, diversified ETF approach designed to grow over time and realistic for someone who is just getting started or rebuilding a portfolio. I would start by allocating 40% of the portfolio to U.S. stocks through the Vanguard Total Stock Market ETF, ticker symbol VTI. This ETF provides exposure to nearly the entire U.S. equity market, including large, mid, and small cap companies. Instead of trying to pick winners, VTI allows you to own the market itself and participate in long-term economic growth. With its extremely low expense ratio and broad diversification, this 40% allocation becomes the foundation of the portfolio. Next, I would allocate 20% of the portfolio to international stocks using the Vanguard Total International Stock ETF, ticker symbol VXUS. This allocation provides exposure to developed and emerging markets across Europe, Asia, and Latin America. By dedicating 20% to international equities, the portfolio reduces its reliance on the U.S. market alone and gains access to global growth opportunities that may outperform at different points in the cycle. I would then allocate 20% of the portfolio to bonds through the iShares Core U.S. Aggregate Bond ETF, ticker symbol AGG. This portion of the portfolio is designed to reduce overall volatility and provide stability during equity market drawdowns. AGG holds U.S. Treasuries, investment-grade corporate bonds, and mortgage-backed securities, making it a diversified fixed-income allocation that balances the risk taken on the equity side. To diversify beyond traditional stocks and bonds, I would allocate 10% of the portfolio to real assets using the Schwab U.S. REIT ETF, ticker symbol SCHH, with the Vanguard Real Estate ETF, VNQ, as a comparable alternative. This 10% allocation provides exposure to income-producing real estate sectors such as residential, industrial, and data centers, and can help offset inflation over long periods of time. The final 10% of the portfolio would be allocated to a growth tilt based on personal conviction. One option would be the Invesco QQQ Trust, ticker symbol QQQ, which provides heavier exposure to large-cap growth and technology-focused companies. Another option would be the Vanguard Russell 2000 ETF, ticker symbol VTWO, which offers exposure to small-cap U.S. companies that tend to benefit during economic recoveries. I would choose one of these options, not both, and accept the additional volatility that comes with a targeted growth allocation. Altogether, this $1,000 ETF portfolio is built around a 40% allocation to U.S. stocks, 20% to international stocks, 20% to bonds, 10% to real estate, and 10% to a focused growth sleeve. It is simple, diversified, and easy to scale as additional capital is added over time. As the portfolio grows from $1,000 to $10,000 or more, the strategy does not need to change. You simply continue adding money and rebalance occasionally to maintain the same allocation percentages. The key lesson is that successful investing is not about having a large starting amount or finding the perfect ETF. It is about building a solid foundation early, staying diversified, and remaining consistent over time. This is for educational purposes only, not financial advice, but the framework matters far more than the exact dollar amounts. When your portfolio is small, the biggest advantages you can give yourself are diversification, low costs, and consistency. If you found this helpful, make sure to subscribe to the ETF Investor for more straightforward ETF education and long-term portfolio strategies. Let me know in the comments how you would allocate $1,000 in 2026, or if you'd like to see a more aggressive income-focused or recession-resistant ETF version of this portfolio. I read the comments and often turn your ideas into future videos, so your feedback directly shapes what comes next on the channel.